Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. And today is my great pleasure to be welcoming Ron to the channel. Now, guys, talking about ROI, Ron and his fund have posted some very impressive numbers recently. Looking at my screen right now for calendar year 2021, the fund returns net of fees, we're talking the all cap fund, 27.52%, the small cap income fund, 36.95%. And over the last 3 years, net of fees since inception, we're talking the all cap 32.81% and small income at 23.85%. So that, I think, speaks volumes. And I wanted to put it into the introduction because it's very, very impressive. And so, Mr. Ron Shamgar, welcome to the channel. How are you doing, sir?
Hey Ben, how you doing? I'm good, thank you. Thanks for those kind words.
No, my pleasure, man. I think that's a very impressive performance, and I definitely wanted to get it out there and make it crystal clear for people that the runs that you've put on the board are certainly impressive, and the ability to outperform and gain that ROI is what we're all about on the channel. A little bit of housekeeping, guys. Nothing said today is advice, so it's just two guys who love investing, having a chat. Make sure you do your own due diligence, and you are responsible for your own financial decisions. Ron, if you don't mind, I'd love you to give us a 2 to 5 minute introduction into you yourself, who you are, where you came from, and how you got so passionate about investing that you ended up where you are now, which is a professional investor and a very, very good one at that.
Yeah, sure. So, I mean, first of all, I'm the head of Australian equities for Tamim Asset Management. So we're a boutique investment firm based in Sydney. We basically, cater to wholesale investors and retail investors as well, but mostly deal with the high net worth clients. And we offer them 2 Australian equity strategies, 2 funds, which I manage both. We also got we got a credit fund, some international equities, and a property fund as well, which other people deal with that. I started investing in the stock market just almost 20 years ago. Maybe shows my age.
I don't know, how old were you when you first started?
That was probably 20. I was 24. Yeah, 24. Yeah. I mean, I went through. I mean, I guess through those 20 years, I went through quite a lot. I went through the bull market of up until the GFC, went through the GFC and, lost some good money and sort of, learned not to go swimming naked, so to speak, like the old Buffett saying. And then after the GFC, I really kind of realized that where the best way to make money that I think in this market, especially in Australia, and where I can add the most value as well, is in that sort of small cap end of the market. I felt like I get really good access to management. They're willing to meet with you, and you can find things before everyone else. And that's where you can really make really good money, find a good story. And then when everyone else finds out about it, that's how you make your money. So I did that. I was just a private investor managing my own money, my family's money. And then a few years later, I decided to become a fund manager because investing was one of my passions and that's all I wanted to do in life. And so I didn't really go through the traditional funds management way of studying and then working for someone and then climbing up the ladder, so to speak, and becoming a fund manager. I actually started through a Facebook page, thanks to Mark Zuckerberg. And I launched a Facebook page called the Boat Fund back then. And back then, this is over 10 years ago. So social media and finance, it wasn't like it is today. There wasn't like Twitter finance, there wasn't TikTok and all that stuff. So I started writing about all my stock picking ideas, and it became a very popular page, really great discussion about stocks. I had thousands of people following. And after doing that for a year, I met someone within the industry and, using his license and so on, we launched a fund together and I ran that for almost 5 years and it was quite successful. We did about 15% per annum net of fees during that period. And then after that, we went our separate ways. And 4 years ago, I joined Tamim and I managed the 2 funds for them. And it's been good. Obviously, some of those returns that you mentioned, they are a bit lower now because this year has been a bit of a tough year. But they're still 15% per annum net of fees, and we're just going to keep going and
It's a
get those
downside
back
better
up.
than the S&P this year, sir. So I think you're keeping your head above water. And guys, if you're not following Ron on Twitter, you should be. Details will be in the description, as will details and links to Taman Asset Management if you are looking for a fund manager to manage your investments, such as Ron. Well, that's fascinating. I've got to ask you about that process of when you were starting a fund with your friend. Tell me a little bit about that. The good experiences, the bad experiences. Did you find it easy to raise capital? How much capital did you get under management to get the ball rolling? That just to me is a fascinating story. Tell us a little bit about that.
Yeah, sure. So, it was interesting. All up, I was managing $50 million through that period. But it was quite interesting because during that year of that Facebook page, and I put a lot of time interacting with people and so on. It was a really good discussion. You built a relationship with people that you never met in your life. And then when we launched the fund, I actually got $10 million of investment from strangers all across Australia. They never actually personally met me, but they developed a relationship and a trust through that Facebook page.
Your writing on Facebook.
Wow. Yeah. So that was quite amazing, I thought. And then we just kind of raised money. And I guess the ups and downs in this game is that when you're a private investor, and we all make mistakes. We're all going to get some of our picks wrong. It's just the nature of this game, and you try and minimize those. And the more you minimize, the better your returns are. But when it's just your money, you can kind of like get punched in the face, and you get only yourself to blame. And I guess when you're managing other people's money, then investors seem to only remember the the bad times, not the good times, and you have to remind them that it's a long-term game, and you're going to go through a bit of tough times once in a while, but over the long term, if you keep sticking to the fundamentals and doing what you're doing, and instead of ignore the noise, you tend to do really well. And it's quite amazing actually that when things are going gangbusters, and you've just delivered a 50% return year, and the markets are flying, everyone wants to invest. And when you're down 20%, the market's down, that's the time to invest. Yeah. Nobody wants to invest, right? It's quite funny, but that's just the human nature.
It is. And how do you manage that in terms of educating your clients when you're going through the good times to say, yeah, look, I know things are going really well, but we're starting to get very frothy valuations. Maybe we're looking at trimming some of the positions, raising some cash in the portfolio, taking some profits, versus when things are really sort of fearful and bad and people are like, they're worrying, they're calling you. What are some of the conversations that you had around that? Because I think it will help listeners to get over that counterintuitive sense of people panic when they see the red days, and yet they get all excited when they see the green days. And like you said, when you go to invest, you almost want it to be the opposite way around, which is completely counterintuitive to our wiring.
Yeah, sure. Look, personally, I'm always been an optimist, right? And I've been doing this for 20 years, and I never tried to time the market. I never tried to pick, things are frothy and let's go to cash. Because I believe that at the end of the day, if you buying good businesses that are going to continue to grow, every once in a while there'll be a crisis and markets will drop. But if you can ride through that, if you can stomach that volatility, then usually you recover quite quickly. I mean, if you look at the last 20 years, and I've been through, the GFC, everything in between. We had COVID, everything in between. Now we've got sort of this kind of inflationary interest rate kind of market that was pretty bad this year from an historical point of view. They usually tend to last for quite a short period of time. It could be anywhere from a few months to 12 months, or maybe 15 months for the GFC, from sort of peak to sort of a recovery. So you just have to, you can't time it. You can't, last year, in hindsight, sure, it was the time to cash out, but I mean, you just never know, because you could have said that after 2019, the markets were up 25%, we did like 50%. And then, the next 2 years, if you just take out that COVID crash, were amazing. 2020 was good after the COVID crash, and then 2021 was also an amazing year. So had you tried to time it at the end of 2019 and said, oh, everything looks expensive, the market's gone hard, then you would have missed out. And that same thing with this year, it's been a tough year. We're coming out of it, and you just have to keep going and focus on fundamentals. Just block out all the noise, the media, the headlines. I don't really bother watching all those mainstream business channels. There's just no point, because all they do is just feed you with panic, and usually you should be doing the opposite of what they're saying.
The Jim Cramer reverse index.
The poor guy has been copying it.
Well, that's why we've got him on hopefully a good stream of media, the ROI channel. So that is a nice segue into some of your processes. I'd love to dig into your brain and talk about, let's say you're starting a portfolio from scratch that you're going to manage. How many positions are you comfortable holding generally? What sort of weightings are you looking towards each position? And then how do you work your way through the investment process when you finally go to make a decision and buy an individual asset? Let's call it a stock for an equity portfolio. How many positions are you normally running, and what sort of weighting to start with?
Yeah, sure. So we usually own anywhere between sort of 30 to 40 stocks in each fund. Now, there could be a long tail to that. So obviously you may have businesses that you understand better, are doing really well. You've been sort of following or investing in them for quite a few years. The management keeps delivering what they say. They got a great track record. You've got a lot more conviction on that, or the valuation is more attractive. So you can have higher conviction in maybe in 10 stock, and then you can have maybe a long tail in the rest of the portfolio where you're building a position slowly. You want to take your time, see whether they prove what they said they would, and then you can add to that. And sometimes you're actually exiting positions. But again, you don't do things within a day. You might be exiting slowly because you want to take profits on the way up, or sometimes it's illiquid, so it takes you a while to get out. Or, so there might be sort of, even if you own 30 to 40 stocks, you might be exiting some over a period of time, and then you might be building a position in others. So it can move around. What I've learned over the years is that, if you look at our returns, if you look at the 3 years prior to this year, we're doing 30% per annum, and then up until now, 15% per annum after a bad year. You can still do it by owning 30 to 40 stocks, but you're not going to blow up your entire portfolio on one position that you thought, this is an amazing opportunity. I think I understand this business so well. I'm going to go hard into this. And then out of the blue, they lose a contract, they announce a downgrade, something bad happens. And what I've learned is that no matter what an analyst, a fund manager, a broker, or an investor tells you they know a business, we only know this much. Because at the end of the day, we get to have a little peek twice a year at their financials, half year, full year. Maybe if you're lucky, you get a quarterly cash flow report. And at the end of the day, we don't really know what's going on. And we have to make a lot of assumptions. We try to, obviously, it's important to meet these managements and really try and understand the business. And the more you meet and talk to them, the more you get to understand. But there's been businesses where I've been invested in for 5 years, and after 5 years, suddenly you learn something new, because that's why I've learned that no matter how confident you are, you have to diversify, and you can't bet the house or the farm on any one company, because you just never know what's going to happen. So we try, so in uncertain times, like for example this year, we try and be a lot more diversified and not take big bets, because there's a lot more chances that you'll get bad news. Whereas in better times, you know, you could take a little bit more conviction, because the chances of bad news or the market reacting to news is not going to be as savage as it is now. You know, you know, this year, if a company downgraded by 10-20%, it could drop by 50% the share price. Whereas if that happened, you know, in the last 3 years prior to this year, which was kind of like bull market, you know, the stock might be only down 20%. So you don't want to take too many big bets when times are uncertain. So that's really kind of how I would categorize it in terms of diversifying. And in terms of the companies that we look for, you know, we are looking for ideally, you know, businesses that are, you know, exhibit what we call sort of strong financial capabilities, you know, growing earnings, generating good cash, which is really important. We're looking for businesses that have got industry tailwinds. So a lot of times the company looks really cheap, but they've, you know, it's a structurally challenged business or a value trap, and you want to try and avoid those. And then, you know, one of the key things that we also look for is that we're looking for catalysts. What's going to make us money by getting other investors to want to buy this stock, right? Because at the end of the day, there's no point owning a company that looks cheap and the share price just never goes up because no one really wants to invest in it. Yeah. So you want to identify the catalyst, and ideally in the near term, in the short term, that will drive the share price higher, will get people interested, because I think it's really key. So, you know, if I look at the kind of business that we want revenue visibility. So ideally recurring contracted revenue. We rarely invest, for example, in mining companies or contracting businesses, you know, because those have really lumpy kind of revenue and sort of profile. You know, we want high cash conversion. So, you know, those earnings converting to cash, ideally low CapEx. And you really got to look into these things. There's a lot of accounting trickeries out there. You know, you can make your cash flow look good, but then in the investing part, you know, it's all chucked in there. So the actual free cash is not much. You know, balance sheet, you want a good balance sheet. So you want, you know, we're not afraid of debt, but you don't want companies that are over leveraged, because it can really come and bite you. You know, ideally a business that has some sort of pricing power, which, you know, in inflationary times like this, it's a really great hedge against inflation, right? You own stocks that can raise prices. You know, equities are good in times of inflation. And then really in the small cap space where we invest, probably the most important factor is the management, because, you know, you could put anyone to run an ASX 50 company and they're not really going to blow it up because it's too much of a big business. Whereas these little small caps, you need the right people. And so you want people that have a track record. And, you know, and the thing is, you know, I've been doing this for 20 years. So you actually tend to know a lot of management teams or directors that have gone from one company to the next over the years. And it does give you a bit of an edge knowing that, because you remember, oh yeah, that person, they were really good. I remember that we made a lot of money. Now they've joined this company, you know, this is worth taking a look at, or, you know, this is a big tick. And I'll talk about one that we made a lot of money because of that. And then others, you remember, oh no, those were a disaster. Like avoid this company, you know, now that they've joined. So it's really important. And then I think we want to look at the big picture. So I think sometimes investors, analysts, they get bogged down into the little fine details of, you know, what's going to be this sort of balance sheet line or P&L line in 2 years from now. Even the CFO doesn't know that. So the key is just understanding what's going to drive revenue and profits, the big picture over the next couple of years. And, you know, if they got tailwind, structural declining business. And then, you know, once we identify that finally, and it ticks all the boxes, you want to basically do a valuation of the business. And there's multiple ways you can value a business, whether it's you look at some of its peers and the multiples that they trade on, you can do a DCF and so on. And, you know, I like to say that, I have a saying that it's better to be approximately right than precisely wrong. And this is really important when it comes to valuations, because, you know, whether this stock is worth 80 cents, $1 or $1.20, it doesn't matter because I'm trying to buy it at 50 cents. And that's really the key, right? So, trying to get too, too particular and precise is not the recipe for making money, I think, in the stock market.
There's a lot of wisdom. There's a lot of misplaced precision. Okay, so we've got a top down looking for sectors with tailwinds, and a lot of what I'm hearing is you're really looking at the qualitative side of a business, which is not always easy to see in black and white numbers. So yes, you can see revenues, sales growth, and repeated contracted order books going out into the next few years, and then how much of that is dropping to the bottom line. But this wild card, which you seem to be very, very good at, is the ability to assess management, which you mentioned. How much time do you spend talking to management? How do you assess them, other than obviously looking at their track records, which you mentioned? How important is management when we're dealing with definitely sub $1 billion market cap, sub 500 million market cap? Where's the sweet spot for you in terms of where you like to operate, and how do you really get a sense that this management is going to live up to your expectations?
Yeah, look, there's a lot of elements to that question. I mean, first of all, I think ideally on the ASX, the sweet spot is, I think, in that sort of sub 200, sub 100. In fact, in fact, the best opportunities you probably find where you make the most of my money is sub 100, because usually a lot of funds can't really invest in a sub 100, so they're waiting for it to get bigger. And then obviously also from a broker coverage and so on, there's less people covering it. So there's more opportunities, but then again, there's more risk as well, right? In terms of management, obviously you got to look at the incentives. Apart from their track record and what they've done in the past, you got to look at some of their incentives as well. Have they actually bought shares with their own money, or were they just getting, free options? So they don't really, it's kind of like they've got like a free option on the upside and no downside if things don't go well. And it's really just about meeting them. I mean, yeah, we meet management teams all the time throughout the year, with hundreds and hundreds of companies. And the only way you can really tell is whether you have a really good sort of read on people, like, I don't know, maybe you play poker or something, or it's just over time, right? So you have to, sometimes you meet with management teams and you come out of there and you feel like you need a shower, if you know what I mean. Like, you can just see it's all spiv, and it's just yeah. And and it's just, you got to have a bit of intuition, but at the end of the day, a lot of times it's just time. Like, you meet with them, they tell you something, if they deliver, that's a tick. You meet again, they deliver, that's a tick. And then you build that trust. And that's why sometimes you want to build a position over time. And that's what I meant with conviction, is that eventually at some point you've got that conviction to go big, because everything ticks the box, and then the management, the people that you can trust, and everything they've said in the last few years, they've actually done. So yeah, that's really, I think the sort of the different elements to this.
Okay, it's very interesting. And switching to a little bit of macro, which you've touched on, everyone's talking about inflation. The US, monetary policy seems to be tightening, and that's putting pressure on various markets around the world. RBA seems to be looking to slow, shall we say, or pause the pace of the rate hikes, because we may have some issues in the property market. Where do you see the macro environment heading in towards maybe the next 1 to 3 years? Have we hit this idea of peak inflation, and so people are overreacting, or do you think we've got some more pain to come? And so you're really digging into whether a company can maintain their margins in an inflationary environment. I'd be interested to get your thoughts on that.
Yeah, sure. So, I mean, I think that, at the end of the day, we're investors. So what matters is what the market does, right? And, I keep telling investors that bad economic news is good news for investors. Okay. So why is that? Because, if the economy is heading to tougher times, we know that central bankers are not going to have to sort of increase interest rates too high or they may even, have to sort of pause, which we think is going to happen soon, and maybe eventually cut them. But so bad economic news just means less interest rate hikes, and the market moves from interest rates, right? Valuations are sensitive to interest rates, so that's really the key. So you don't want to see a housing market going through the roof. You don't want to see retail sales going through the roof. You don't want to see unemployment go lower, because that's good economic news, very bad for markets, because interest rates are going higher, which means markets will go lower. So I think what we're starting to see, and now, even though we live in Australia and we invest in Australian businesses, it's funny that all that matters is the US market. So all that matters is what's happening in the US economy, because the US economy will decide what the Federal Reserve does over there, which will then decide what the US markets do, which is exactly where the Australian markets will follow. So the Australian economy is almost irrelevant in a sense, right, to the markets. So I think if you look at what's happening, I think that if you look at the US economy, it's really starting to slow down. I think if you look at the housing markets over there, we've seen data that shows that home sales are falling at the fastest rate since 2008. Building permits are at 3-year lows, and all these are leading indicators for the economy. Consumers all over the world, because of the lockdowns of COVID, they've all saved up money. So retail sales seem to have been quite resilient this year all around the world. We've seen that in the US and Australia, but that was essentially, people kind of eating into their savings. And I think now we're starting to see that sort of personal credit the balance is going up, right? So people are actually going through tougher times. They have to start borrowing again. And so I think we're starting to see that in a lot of retailers starting to report some slowdowns in the US. And when Walmart and the Targets of the world over there are doing well, it's a bit tougher, right? So I think that's bad economic news, great for stock markets. And I think we're already seeing the Federal Reserve, they're already admitting that there is a bit of a lag effect from all those interest rate rises. It just takes time to filter through the economy and to slow things down. Inflation has definitely peaked. It hit a high of 9% back in June. We're seeing that coming down. Obviously, it was a better number in October than was expected. In October, which was reported last month. And obviously, the next one is in 10 days, 12 days. We'll find out. But, we saw the number in Australia yesterday, and that was better than expectation. So I think we're starting to see a lot of the metrics that go into these inflation figures, used car sales, look at container freight index, for example, pre-COVID cost you less than $2,000 US to ship a container from Shanghai to LA. It went up to 12,000 US at the sort of peak of COVID supply chain bottlenecks. And now it's back to 2,000. So, all of those
I learned that the hard way. I was chasing it on the way out with some of the container companies. But anyway, that's a subject for another day.
Yeah, so we've seen, gas prices are coming down, a lot of industrial commodities. And so I think those things are starting to show in the numbers. And usually, if you look, so that's kind of like goods inflationary issues that are rolling over, and that tends to lead services, which is still relatively high. So services inflation was still rising, but that will start coming down. And then wages are a bit more sticky, but as long as whatever the wage rise that we're seeing now, as long as that doesn't increase again over the next 12 months, then that's not going to be an issue for inflation. So I think what's going to happen is inflation will keep going lower. This time next year, I think inflation will be like a non-event. No one's going to be even like talking about it. It will somewhere between sort of 2 to 4%, let's call it. And I think most of the interest rate rises are done. In Australia, definitely, because we have a lot higher, more sort of household debt, mortgages. So we are a lot more sensitive, and I think the Reserve Bank
debt too, really.
Exactly, and in the US, it's less so, and so I think that over there they could go a bit harder, but they're already starting to see all these impacts. So I think they'll go a little bit higher in the US, and then they'll pause. Now, if you look at history, history shows that every time since the 1970s, every time after an aggressive interest rate hiking cycle, every time the central banks stop, or more specifically the Federal Reserve, which is what matters, markets rally between 20 to 30% once the Fed pauses. So we think the Fed will pause sometime by March next year. And so we think the market's going to be really strong next year. It's going to be a really good, equity market, and I think
have
that's
you
why
got
I think you want
target
to invest.
of Fed funds rate you think they can get to? Like a lot of people talking about 4.75 to even 5% from a terminal rate point of view.
Yeah, look, I mean, I think what the market's pricing is reasonable. They're at 3.85 to 4% at the moment. I think they'll do another 50 bips in December, and which is what the market is expecting. If they do less than that, then melt up, like we saw. And then I think they might do either a couple of 25 bips or something like that early next year. And I do believe, unless inflation goes up again, which I doubt, but I believe that from March on they will pause, and then at that point markets will rally hard. And then there's another thematic that's not really being talked about, and I've tweeted it today, is that that sort of the Chinese kind of COVID zero policy lockdowns. I think they're starting to realize that it's not realistic. There's riots in the street, and I think that they're going to ease those policies and they're going to start reopening the country next year. And that's a very bullish,
huge source of
theme.
Demand for commodities, right?
Commodities and just the global economy. So I mean, look at Apple, right? Like they're being impacted with iPhone sales, because they can't get manufacturing factories to operate in China. So I think it's going to impact everyone positively, and that will be another thematic that will play out next year, which will be positive for equities as well. So I'm generally optimistic. I mean, I think most of the pain that we went through this year, I think we've gone through it. And it might be a little bit volatile here and there, but I think we've gone through the pain, and you definitely want to be invested over the next few months, because I think it's going to be a good year next year.
Yeah, it's interesting. It's somewhat contrarian. There has been a lot of fear recently on the back of these rate rises. Do you expect so we may have a pullback in terms of inflation? Where do you think that's going to settle? Are we going to get back to that world of, central banks targeting 2%, or are they going to say, oh, look, we've run up too much debt here, we're going to let it run to maybe 3 or 4% as our new target range, versus over the next, 10 years, a lot of people talking about a stagflationary decade where, you've got inflation cooling off again, but then given a lot of the restraints in the energy markets in particular, that's going to be a driver for an inflationary decade. Where do you see all that falling over the next short, medium, and maybe long term for the decade?
Look, it's difficult to predict these things. I mean, this could be maybe an unpopular kind of opinion, but
I love those. They're my favorite kind.
I think this time next year, the word deflation will start popping up, especially if central bankers or the Fed goes a little bit higher than what's needed. I think you'll see the US definitely fall into a recession, and and I think we definitely start talking about deflation. I mean, we're seeing everything coming back down. The only thing that's really still tight is the labor market, right? But if you think about the labor market, the way I see it is that COVID, because the way governments reacted with COVID, they shut down their borders, and that whole international labor flow that flows around from countries that have poor people that come working in jobs that no one wants to work in hospitality or whatever, they've all been sort of locked away from these countries in Australia, the US. And so we've, who's had shortages? There hasn't been shortages of lawyers, and that there's been shortages of
jobs.
Fruit
pickers.
Fruit pickers.
Yep.
There's a company listed on the stock market. They're called Millennium Services. They're one of the largest contractors. They provide security and cleaning for shopping malls and offices. We don't own them. Terrible business, but talking to management, they said that the biggest part of the sort of cleaning and security workforce for shopping malls and so on is international students.
Yeah.
And we haven't had those until just recently,
basically
right?
2 years. Yeah.
Yeah. So, like, and nobody, no Australian wants to go and clean or do security in a shopping center. So yeah, it's been difficult, and we know all the documented struggles in the hospitality industry and so on. But I think, and it's all the same. It's not just Australia, it's the US, it's everyone, because all the governments had the same policies in terms of border restrictions and so on. But I think that's starting to really ease up. And I think you'll see that sort of sorting itself up. And so I think that the labor markets won't be as tight, and then we won't have this kind of wage inflationary pressure that we've had. So that's the only thing that's kind of like gets to stay sticky in inflation. But everything else, you really see it coming back to earth. And if you think about what inflation is, it's just the change of price in goods and services over a 12-month period. So from this point on, you don't actually need prices to drop. You just need them to stay flat.
Yeah.
And that's something that you got to think about, because people think, oh yeah, but well, yeah, we don't need things to drop. We don't need wages to go down. We just don't need them to go up for 12 months, right? So that's really the key. So I think
new
inflation
base effect is from a much higher level, because you're measuring it from the previous year, right?
Yep. But we're seeing the pricing increases have gone through, and it's we're all getting used to paying another 50 cents for your coffee and so on, and it's just and the
rest.
Yeah. So I think you're used to it, but there's also other things like travel. You look at trying to fly. Air travel at the moment is a daylight robbery, let me tell you. But that's because airlines haven't brought back capacity. They haven't restarted. A lot of airlines haven't restarted those routes that they used to do prior to COVID. So that will come back on, and again, that will bring back down a lot of those prices of air tickets that we're seeing, right? So I think everything will sort of balance itself out over the next year or two, because COVID really thrown the whole world off balance, right? And it sort of needs to come back. So I think that inflation won't be an issue. But what I've learned over the last 20 years from an investor point of view is that investors always have some sort of concern, right? I remember the GFC, we had that. Then for several years, there was constant concerns about which of the pigs, is going to go under. Was it Greece? Was it Portugal? Was it Spain? And then you had the Brexit, and then you had, all kinds of things. So there's always going to be some concern on investors' mind. But again, that's what I keep saying is you have to kind of just, we don't try and predict macro too much. Just focus on businesses that can keep growing, back the right people, buy them at a reasonable discount to what you think they're worth. And and I think that's really the key here. It's too hard to know what's going to happen in 2-3 years from an economic point of view or interest rate point of view, but I'm optimistic for all those reasons that I mentioned.
That's a fascinating take. I've really enjoyed listening to your thoughts and your tweets. Again, guys, if you're not following Ron on Twitter, you must. It's an absolute education and entertainment all rolled into one. It's ROI time, guys. This is where, hopefully, speaking about businesses, we can ask Ron about some of his best investments in businesses in the past. And then looking forwards, I'm going to try and get a few names out of him in terms of businesses that he really likes. So, my friend, the first thing I would love to ask you is, what is your highest ROI from any investment to date, or what you would consider your best investment? What's one that really sticks out in your mind? And tell us a little bit about that backstory.
Yeah, sure. So, there's obviously, the way I call it is sort of, the portfolio holdings that we have. It's kind of like our children kind of thing, and we love all our children equally, and some better than others maybe. But
I've got a few ugly stepkids in there that I'd like to get rid of.
Oh, definitely. But look, I think we've had, I was trying to kind of think back of what was the sort of highest kind of multi-bagger, so to speak, stock. We've had a few different ones, so maybe I'll talk to a couple of stocks, but there is one which I think kind of ticks all the boxes. We owned it for a few years, and it's a company that got taken out a few months ago called Unity Group. The code was UWL.
Yeah, I know it well. I happened to invest right when they floated. Anyway, sorry, go ahead.
Okay, no. So so I mean I think they made a record. So they IPO'd. Now it's been probably 3 years ago, from memory, or 3.5 years ago, and it was just a crappy little fixed wireless broadband provider run by a married couple. It was a 20 mil market cap, losing money. It was a disaster, right? And basically, I think they listed a 20 mil market cap, maybe 20 cents or so IPO price. And quite quickly after they listed, you had two sort of telco industry veterans, Mick Simmons and Von Bowen, that joined the register, became directors, started aggressively buying shares on market. And basically, these guys have had an amazing track record of building telcos from the ground up and getting taken out in takeover offers. Mick Simmons did Focus, and Von Bowen did M2 Telecommunications, which was a big success. And Focus was a success for many years until everything turned to shit there. So they really took the business, got rid of the management, and they actually changed their business model from doing fixed wireless residential to starting to buy residential fiber assets across Australia. So essentially competing with the NBN, where they were allowed to in sort of greenfield or green acre housing developments or high-rise residential development. So essentially they would provide the fiber and then they would wholesale that, just like the NBN does, to ISPs, internet service providers, and they basically just make huge margins, right? Because once the sunk cost of the fiber goes in the ground, it's all margin. So they built, and they were quite aggressive, and the market backed them, and the share price went from 20 cents to $5. Eventually, the takeover offer. They built a business by acquiring aggressively most of the bigger sort of fiber providers to that market over a short period of time, and they were a super profitable business. I think, from memory, they were doing something like 100 mil of EBITDA, 200 mil of revenue, or even less revenue. I think the margins were even higher. So really great sort of infrastructure business, very defensive, as we all know. Everyone has to use the internet, and they had this contracted pipeline with all these developers across the country, where they would place the fiber in the ground once those housing developments were built or those residential blocks were built. So they had this contracted pipeline of 200,000 or 300,000 lots, and so you knew that over the next few years, as these lots get developed and someone moves in and eventually connects to them, you would knew that their revenue would just keep growing organically, even if they stood still and never won a new business again. They had this huge pipeline. And eventually they got taken out for $2.5 billion, I think, at $5. We bought in at sort of $1.20 mark. So we did quite well, 4 or 5 times. And they got bought out by a New Zealand fund, Morrison, and backed by Brookfield, which is like an infrastructure investment. And I think it set a record, ASX record, for the quickest time for a 20 mil market cap stock to $2.5 billion, which I think it was 2.5 years or something like that, 3 years, whatever it was, which is kind of like I think it's a record. So yeah, an amazing story, and it ticks the boxes of recurring contracted business, defensive, very profitable, spits a lot of cash, and that management with that track record, right? That as soon as you saw their name, you didn't even have to go and check what they did; you just knew straight away. And they bought stock aggressively on market. I won't forget. As soon as they joined, I remember they were just spending millions of bucks buying shares at 20, 30, 40, 50 cents. And you were going like, what the hell is going on here? But they knew what they were doing, right? So that's probably, you're not going to find many examples like that, right? But so that's one that I could say that it worked really well for us. There was another one that actually we made more money on Unity because we had a bigger position there. Because of the reasons that I mentioned, or because of the business fundamentals, you could have more conviction in the management. But there was another one that we actually had almost a 10 bagger. I think it was 8 or a 9 bagger. It's a company called Tesserent, TNT is the code. They're basically like a pure cybersecurity, consulting IT services business. Started off a couple of years ago. It was trading at 4 or 5 cents, which we bought it, and it was backed by, again, someone within the industry that had a great track record, a guy by the name of Jeff Lord, who built a previous company called UXC that was listed. They were in IT services, built it through acquisitions, eventually got taken over. He did really well. So he bought a lot of shares, had a big holding there, and they started acquiring, doing a bit of a roll-up of acquiring all these different cybersecurity providers. And obviously, it was the right place at the right time. Cybersecurity was a great thematic. Prior to this year, they did it through 2020, 2021. Market were buoyant as well. So, they could raise equity and keep doing it. And it went from 5 cents to, I think, 45 cents. We managed to actually exit quite well. So we did really well there. And then obviously now it's come back a lot, like everything. We don't own it. We sold it last year. So we actually timed that well. I'm not a big fan of sort of mentioning that as much as Unity Group, because, it was kind of like a short-lived, maybe sort of 12, 15 months kind
what
of
happens
10
there is
bagger.
involved, whereas
Yeah,
those metrics were just, they were begging to be bought.
Yeah, but so that's one that we did quite well on by backing someone that, again, did it in the past. And so that was quite good as well. But we've had a lot of other sort of kind of multi-baggers that worked out quite well. There's one that's actually under a takeover offer now that we owned called ReadyTech. RDY is the code, software business. We bought that almost 4 years ago at about around $1.20, I think, and it's getting a takeover offer today at $4.50 from Pacific Private Equity. Again, software business, very profitable, sticky recurring revenue. It's in that education and recruitment sectors. So kind of like a little mini Technology One in a sense.
Okay.
Growing organically through acquisitions, management with skin in the game, and they've kind of delivered over the years, and they consistently delivered. And so that's another one that we did quite well on. And it's kind of probably will get taken out now as well.
Okay, very interesting. And looking forward, is there any particular one or two companies that you've got your eye on?
So look, there's obviously, we own a few companies, so we like a lot. I would give one business which I think has a short-term catalyst, which I think the risk reward here is quite attractive. And it's one of those businesses that ticks all the boxes. So it's a company called People In. So the code is PPE. Used to be called People Infrastructure. It's about a 320 mil market cap business, listed about 6 years ago. And they're essentially like a leading listed talent solutions business. So they're like a workforce management recruitment business. It's a founder-led business. And it's just, had consistent growth in all its financial metrics since listing. So if you look at the sort of the graphs in the presentations over the last 6 years, revenue growing at sort of the 27% compound per annum, NPAT-A growing at 30% per annum every year, earnings per share, dividends, sort of everything consistently. And they've done it through both organic and acquisitive growth, but their acquisitive growth has been quite measured. They haven't gone out like crazy and just rolled up a bunch of recruitment businesses. They've done sort of maybe, one or two solid acquisitions each year and really built up scale.
And how are they funding those acquisitions? Are they doing like cap raises, bank debt, or they've got just the free cash that they can use?
Yeah, so over the years, they've been what I would call a broker's wet dream, kind of, so to speak. They obviously raised capital over the years, but they did it in a smart and measured way. Like I said, because they didn't do it in a rush and over many years, the share price, I think they listed at $1. They got to like 450 maybe last year, and then they're trading around low threes now, and they've paid really good dividends over the years. So they've done it in an accretive manner, and they generate really strong cash flows, right? The cash conversion is really high for this business. They pay a 5% fully franked dividend yield, again, consistent every year. And last year they did about 640 mil of revenue, 47 mil of EBITDA. That was about 32 cents EPS, 13 cents fully franked divvy. Now this year they've given guidance they'll do about 66 mil of EBITDA, so really strong growth. So if you ballpark at their current share price, they're trading on maybe 8.5 to 9 times PE, cash PE multiple. Like I said, a 5% dividend yield. Reasonable debt, maybe 1 times EBITDA. Okay. Now, they are big wages inflation beneficiary because they get a margin on the wages earned from the people that they place into jobs. So if you can imagine, if the wage goes up, they just flip a margin on a higher wage. So they're a beneficiary of that. They're obviously a beneficiary of the borders reopening and getting that, a pool of talent, labor coming into the country. They're diversified both geographically across Australia, but also from a sector-wise, which is important. They're big in healthcare, nursing, IT, technology, accounting, and they've got like an industrial sector where they bring people in from Pacific Islands into sort of the industries like agricultural and food and packaging and so on, and it's sort of government-run kind of visa program. So what I like this one, so the valuation is really cheap, great track record, founder-led, management owns shares. What's interesting is that they obviously want to do acquisitions, but the share price where it is, it's not where they think it should be, right? I mean, they're consistently growing and the market is giving them an X growth kind of multiple. So they've announced a strategic review to the business. And basically what they're saying, look, we want to do more acquisitions. We're going to have to raise money. If the market's not willing to price us accurately, then someone else will just buy us and we'll just do this in private hands. So I think, I believe that what's going to happen is that if the market is not going to re-rate the stock over the next few months because they're growing earnings and everything, then you'll see a takeover bid here, most likely for maybe a private equity that will do this roll up, continue to grow in private hands, or maybe an industry player will buy them as well. I mean, like $1 billion of revenue, 60, 70 mil of EBITDA, profitable cash flow generating business. It's quite attractive. They're big enough to attract interest. So I think I see it as sort of like the risk reward is quite attractive because your downside is minimal because of the valuation, and the business has got great momentum. We know the jobs market is tight, and we've seen the lows of the share price already through this year, and it's only gotten to sort of mid-high twos. So you're buying at a 320 at the moment, get a great yield. And then if the market re-rates them because they keep growing, great. And if not, then I think you'll see a takeover offer in the next few months. So I think this is worth at least $5. And I think it's one of those ones that sort of, I'm happy to kind of talk about it because, I feel quite confident about this one. We've owned it for quite a few years.
Interesting. So what will happen to public shareholders? Let's say they do privatize and a PE group comes and takes them out. How does that work? Do they have to go to a vote for the shareholders, or they have to have a certain premium on the offer over and above market price?
Yeah, so I think what they mean is basically, they'll get a takeover offer at a premium. So, 40, 50% premium. And then it depending on, usually it goes to a scheme of arrangement, which means, yes, there will be a vote. Mm-hmm. But, so there's just like any other takeover offer. The board recommends it. It tends to always go ahead unless there's some big shareholder that wants to be a pain in the butt, kind of, so to speak. But that's not the case in this stock. It's all institutionally kind of owned, and everyone will be very happy to get $455. So I think it'll be good. We'll be happy with a takeover.
Interesting. So attractive valuation with the potential kicker to the upside with a takeover at maybe a 40 to even 50% premium. Very, very interesting. Well, thank you so much for joining me today. I had an absolute ball. Is there anything I missed? Is there anything I should have asked you, or is there anything in particular that you want to leave us, the listeners, with before we wrap it up?
I think we spoke pretty much about everything. I think that what I would say to investors is that you know there's a lot. Investing, I think, is an emotional game. You know, you go through some good times and ups, and you go through some down times as well. And I think the main thing is just to kind of stick to whatever processes you have, and don't get too distracted. And you know, and I think over the long term, optimists always win. That's what I would say.
Fantastic. Well, thank you so much. I'd love to catch up with you a few months down the track and have another discussion to see how these winds of change have affected markets. Guys, again, follow Ron on Twitter. Links will be in the description. And for anyone who's interested in Ron's style of investing and asset management, we will have all of his and Tamim's details in the description. Thank you very much for watching another episode of the ROI channel. Make sure you subscribe and share with your friends. And I look forward to catching up with you all in another episode shortly. Thanks, everybody. Take care. Bye.